Hi everyone, welcome back. This is John, and today we will jump into one of the most important topics in all of accounting: journal entries. If you understand today's lesson, FAR become easier, AUD become clear, and accounting will finally make sense. Alright, let's begin. What you will learn today. Here's what we are going to cover in lesson 2: debits and credits, what they really mean. T accounts, your best friend for understanding accounting. The 6 types of accounts, how to write basic journal entries, and how these entries connect to financial statements. By the end of this lesson, you will be able to create journal entries like a real account. Accounting equation review. Let's start with a quick warm-up. Remember the accounting equation? Yes. Assets equal liabilities plus equity. This equation is the law of accounting. Every journal entry must follow it. If your entry breaks this equation, your entry is wrong. So, keep this equation in your mind throughout the lesson. Debits and credits. Now, let's fix the biggest misunderstanding in accounting. Debit does not mean increase. Credit does not mean decrease. Debit simply means left side. Credit means right side. What increase on the left side or right depends on the type of account, and that's what we will explore next. The 6 account types. All accounts fall into 6 bigger groups: assets, liability, equity, revenue, expenses, dividends. Once you know which category an account belongs to, you'll instantly know whether it increases with a debit or with a credit. Debit and credit rules. Alright, that's the golden rule of journal entries. If you understand this, accounting becomes easy. Assets increase the debit. Expenses increase with debit. Dividends increase with debit. On the other side, liability increases with credit. Equity increases with credit. Revenue increases with credit. Memorize this table. This will save you so much time on the exam. T accounts make the zero. Now let's talk about T accounts, the simplest and most powerful visual tool in accounting. Imagine a big letter T. Left side, debit. Right side, credit. That's it. If cash increase, left side. If accounts payable increase, right side. You will use T accounts a lot of doing FAR and AUD. Example 1. Owner invites cash. Let's do our first real journey entry. The owner invites 10,000 into the business. What happens? Cash increase, debit. Owner's equity increase, credit. Journal entry. Debit cash, 10,000. Credit owner's capital, 10,000. Nice and simple. Example 2. Buy equipment with cash. Now let's try another one. The company buy equipment for 2,000 cash. Equipment goes up, debit. Cash goes down, credit. Journal entry. Debit equipment 2,000. Credit cash 2,000. Example 3. Revenue earned. The company earned $500 for service. Cash increase, debit. Revenue increase, credit. Debit cash 500. Credit service revenue 500. Anytime you earn revenue, credit expense paid. Example 4. The company pays 300 for utilities. Utility expense increase, debit. Cash decrease, credit. Debit utility expense 300, credit cash 300. Remember, expense always increase with a debit. Accrue with cash basis. Make it clear. Let's make something very clear. Accrual accounting does not care about cash. It only cares about when something is earned or incurred. This is why sometimes you record revenue before receiving cash, and record expenses before paying cash. This concept becomes critical in adjusting entries. How journal entries connect to financial statements. Here is the big picture. Assets, liability, and equity balance sheet. Revenue and expenses, income statement. Net income flows, retained earnings. Journal entries are the foundation of all financial reporting. If you understand these, the financial statements suddenly make sense. Common mistakes. Here are the mistakes new students make all the time. Thinking debit increase, not always. Confusing liability with expenses. Forgetting to balance entries. Mixing cash basis with accrual basis. Don't worry, you're already doing better than most. Tips for accuracy. tips for fast, accurate journal entries. Here's a quick 3-steps method I recommend. Step 1. Identify the type, the account type. Asset, liability, revenue. Step 2. Decide if it is increasing or decreasing. Step 3. Apply the debit credit rules. Follow this system and you will handle journal entries confidently in the exam. Practice exercise 1. Let's practice. A customer paid 200 in advance. Cash increase debit, but the revenue is not earned yet, so an earned revenue increase credit. Debit cash 200, credit unearned revenue 200. Practice exercise 2. Practice number 2. The company pays 150 for salaries. Salary expense increase. Debit. Cash decrease. Credit. Debit salary expense 150. Credit cash 150. Practice exercise 3. Last exercise. The company received 400 from a customer who owed money. Cash increases. Debit. Account receivable decrease. Credit. Debit cash 400. Credit account receivable 400. Lesson summary. Alright, let's wrap it up. Today we learned how debits and credit really work, 6 account types, how to use T accounts, basic and very common journal entries, how entries connect to financial statements. Great job. Journal entries are a huge part of FAR. Next lesson. In the next lesson, lesson 3, we are going to cover adjusting entries, accrual accounting, and revenue recognition, which are some of the most high-yield topics on the FAR exam. I'm John, and I will see you in the next video.